Hi, everyone. Thank you for joining Midland Pulse, where we discuss topics within the self-directed IRA industry in 30 minutes or less. During this session, Brad Janitz of Midland Trust interviews Mark Shore, an instructor in the Department of Finance and Real Estate at DePaul University, on managed futures as an asset class, as investors look for new ways for diversification in 2021. Let's get started.
The stock market can be a roller coaster, one that not only makes your stomach drop, but your hard-earned cash drop as well. Midland Trust has your ticket to self-direction that allows you to diversify your retirement portfolio into alternative assets outside of traditional stocks and bonds. Once on the self-directed IRA train, you're the conductor, and you can choose to stop and invest in real estate, hard money lending, futures and forex, private equity, as well as many more alternative investments. All gains grow inside the account tax-free. Investing with a self-directed IRA is easy. You can get off of the stock market roller coaster at any time by making a full or partial tax-free transfer to a Midland self-directed IRA. Then you choose your own investment and let Midland Trust take you on a new investment ride. For information on how to self-direct your retirement funds, visit www.midlandtrust.com/diversify or call 239-333-1032.
All right. Thank you, everyone, for joining us today on our Midland Pulse session about managed futures. My name is Brad Janitz of Midland Trust, and I'm joined today here by Mark Shore. And really what brings us to this topic is that we at Midland Trust specialize in providing the ability for individuals to put retirement money to work into alternative investments. And one of those investment arenas is the futures markets. And people participate in the futures markets in a lot of different ways. But one of those ways is to explore managed futures. And so we thought we'd take this opportunity to bring in an expert and hear a little bit more about what exactly is managed futures. And so that expert would be the wonderful Mark Shore. Mark Shore has over 30 years of experience. He frequently writes industry-related content on asset allocation, commodities, macro events, lots of stuff for people smarter than me. But more importantly, he was a director of CoQuest Advisors. He's participated in lots of organizations, and he's an adjunct professor on managed futures. So we wanted to again thank Mark for being here with us today, and look forward to the insights that he's going to offer. So with that said, Mark, can you just maybe start us off and just talk a little bit about what is managed futures?
Sure. First of all, thank you for having me here. It's great to be here. So managed futures, if you think about it, these are professional money managers who are trading the futures markets. If you think about mutual funds, right, those are professional managers who are trading stocks and bonds. Here you have managers who are trading in futures and currencies. Now, they're often referred to as commodity trading advisors or sometimes as CTAs, not to be confused with the Chicago Transit Authority. And that does happen on occasion. But these managers, so they are trading the futures markets. A lot of them tend to be more systematic in how they trade. A lot of them tend to be also trend followers. So they're looking for breakouts in the markets, right? If you think about a trend occurring, it means it's going from sideways action and then it breaks out either to the upside or to the downside. And they're trying to exploit that move. Not try to catch the bottom or the top, but if they can capture, 60, 70%, 50% of that move, that's pretty good. And so you have the managers who do those things. And in that, they are also, they are trading, if you think about it, they're trading multiple markets, right? So in the futures markets, you have financials and you have commodities. In the financials, you have equities and fixed income. You have also currencies, commodities, crude, grains, and energy markets, the softs, which is almost like it's like saying other, right? It's like things you can't put into a category: sugar, coffee, cocoa, lumber, things like that. So you have some of these managers who may be trading one market. Maybe they're just trading corn, or maybe they're trading a sector, so they're trading the grain sector. Or maybe they are trading across various commodities, or maybe they're just trading financials. Or you'll have some that trade a combination of financials and commodities, so they're more diversified in their portfolio. So these managers, they, like I said, they use systematic trading models often. What's probably referred to today is more of like algos, are also referred to sometimes as a black box. And the term black box simply means because you don't necessarily know what's in that model, or the investors don't know. As someone who used to develop systematic trading models when I was at VK Capital, I would say those are actually more transparent than someone who's a discretionary manager, right? Because if you're discretionary, it's based on your opinion, your judgment, fundamental analysis. Here, it's something systematic, and you know what the rules are, and it's all rules-based. And so you can then plug in data for various time periods and say, okay, how did it do in from 1990 to 1995? How did it do from 1995 to 2000, from 2000, 2005, and so on, right? So you can test it in sample and out of sample data periods and see how does it work. And then, does this tend to work in one type of period? Does it tend to work more robustly in different scenarios? But this is more or less how the managers think about it. The other part is the risk management. How do they manage their risk? And so you have to look at this and kind of say, okay, well, a lot of these managers tend to use stop loss, right? So buy stop, sell stop, things like that. They may use that to get into the market, but they're more likely to also use it to get out of the market. There may be a triggering mechanism that they see that occurs in the market to get them in, and then use a stop loss potentially to get them out. Other methods of risk management would also include being diversified within their portfolio, right? That can smooth out the overall portfolio, but when you're looking at individual markets, they could use stop losses. They could also use the size of the position. So if they think they have, if the algo is telling them they have a stronger signal, they may put on a larger than normal position. If it's a weaker signal, maybe they'll put on a smaller than normal position size, right? So they can use that to adjust their risk as well. They could also be hedging. They could be overlaying different strategies within their fund. So that can also kind of help smooth out the portfolio. So you have various components like that. They also can be more seasonal. Maybe they're trading the grain markets at certain times of the year, energy markets at certain times, or particularly with commodities, it can be more seasonal into how they trade. They could be directional, meaning they're looking for a market to go up or a market to go down, and they're just trying to capture that direction. They could also be trading spreads. Now, the spreads could be among different markets, right? So maybe they're trading corn against wheat, or crude against natural gas, or something like that. But they could also be trading it within one futures market. So if you think about, there's something referred to as a forward curve, right? So you have like the front month, the first expiration month, and then you have the back month, and then all the other back months of a futures contract. So maybe they're trading the first month against the second month, or the first month against the third month, or maybe they're trading just some back months. So they could also be spreading in there. They could also you have some managers that just trade options. So they could just be trading options on futures as well. So you have all these different components that come into it and play into this. Now, some people would say, well, okay, that's great. What does all that mean? Well, part of it is that it allows these managers generally as a group to be more diversified or non-correlated, let's say, from equities, right? So you start to add up how they manage the risk, how they trade their portfolio, and also they could be trading intraday to maybe holding positions for a couple of days, a few weeks, a few months, or maybe even longer. you'll find a lot of these managers may hold positions anywhere from a few days to several weeks or several months. But so you get this wide spectrum of markets they can trade, and of where the duration of how they can trade, right? So how long they can hold the positions and how they manage the risk. You take all that together, and it starts to build a story as to how they can be non-correlated to equities. So that kind of sum it up?
No, that was great. A follow-up question to that. So, you're obviously talking about how these managers, they trade a variety of markets in a variety of ways. Is it common for a manager, when you're kind of seeking out who to kind of hire to manage your money, is it common for a manager to trade one specific instrument, such as maybe oil futures, or and then you look for other managers that do different things, like trading cord futures or the S&P, or do you find it that you have managers that are trading kind of lots of different instruments all within kind of one strategy?
So you'll have a combination. So you're going to get some managers that will just trade one market or one sector, and that's what they specialize in, and they've developed methodologies for that. You're going to find some that are going to be more robust. They're trading across various markets and sectors, and they could be trading both commodities and financials. Now, they may take one methodology and kind of tweak it a bit here and there for these different markets. The idea is that they're also looking for robustness. So you get this combination of it. And going back to my roots of what I used to do in developing trading models, that's also how I would do the research, right? I would look for robustness in trading. Okay,
that makes sense. And so let's kind of put this in practicality terms, and you did answer this a little bit, but why would somebody kind of consider managed futures in their portfolio? I mean, so when you look at people, they may have they've maybe been taught through education, just through marketing, that you have 80% stocks and 20% bonds or whatever. And so who or kind of why would you bring this element into your portfolio when it might be a little bit newer to you conceptually?
So kind of coming back to what you just said about stocks and bonds, right? So-called 60-40 mix, which is a common mix, which has been around since about the 1950s or so.
Sure.
Prior to that, you could actually see it was the opposite. There's research showing that often investors were trading 60% fixed income and 40% equities. And then there's various reasons in that time period as to why they did that. In fact, if you look at institutional investors prior to about the 1920s or 30s, they looked at equities as being an alternative investment, right? Their investments tended to be a lot of fixed income, real estate, things along those lines. And then so what's happened is that it's evolved over time, right? Asset allocation. So it go from the 50s, 60s, 70s, where it was primarily stocks and bonds, and then you start moving to 80s, 90s, and post 2000, and you saw investors more and more were diversifying their portfolio. They were looking for things beyond just long domestic stocks and long bonds. So where do you get that? Well, one is you start looking into the foreign markets, right? But then once again, you're going into fixed income and you're going into equities. And there's a high correlation, especially now, more so than ever, because we're such a global economy, that going into foreign markets doesn't really get you the diversification you need. But so you start looking, well, where else can I go? So one of the places people start looking to alternatives, such as hedge funds, managed futures, things along those lines. And so the argument really is that it can add diversification to your portfolio. So kind of what I was saying earlier, that you put together everything that they do, right? All these managers, how they manage the portfolio, what they trade, the duration, and it creates more of a non-correlated product relative to equities. Generally speaking, manager by manager, you're going to find variation to that, but overall, as a group, as an asset class, they tend to be non-correlated to equities. Now, when equities are rallying, they tend to be more positively correlated. When equities are declining, they tend to be more negatively correlated, hence the non-correlation. Now, some people say, okay, that's great. Well, they can be positively correlated to equities when equities are rallying. Yeah, they can also underperform equities potentially when equities are rallying, especially when you get some really large long-term moves in equities, but they're still there. But the idea is that it works as a diversifier in the portfolio, because what has shown time and time again is that when there are shocks to the system and equities decline, especially quickly, I mean, 2008 was a really great example of that. And equities took a big hit. You saw managed futures, CTAs, as a group, were actually doing pretty well, because they tend to look for large moves, right? A lot of them are trend followers, not all of them. You have some that are doing various different strategies, but if a lot of them are looking for trends, that's when you get these trends. And so that's when you get the shocks to the system, and and it works as a diversifier to the portfolio.
Okay, that makes a lot of sense. And so one thing I want to just pivot a little bit here and apologize, because I totally left this out in your bio that DePaul, where you are an adjunct professor, is where you received your MBA, and also where you are going through your doctoral program. And I thought your dissertation, when we discussed, offline, was very interesting to the concept. So, as we move into 2021, I think, we're about to enter peculiar times, and I think people are just thinking overall a lot about their investment strategies. So I thought this would be an opportune time for you to bring up the subject matter on your dissertation, and just talk about portfolio construction, and as we move into 2021.
So, okay, so to start with my dissertation, which is something I like to talk about, and when it's finished, I'll be even happier to talk about it. But my dissertation is looking at managed futures and hedge funds. So taking all of these together and looking at by AUM, assets under management. The hypothesis is that there could be added value to go into the smaller managers, simply because they tend to be able to go into the markets that are not quite as deep. They tend to be able to get in and out of markets easier. There's an added benefit to go into those. The larger managers, it's harder for them to go into the smaller markets. They tend to have to move into the larger, deeper markets, and a lot of those markets may be more correlated to each other. So there's added benefit to go into some of the smaller managers. So that's the hypothesis that I'm looking at. So, and I've seen that too, being in the industry, and that's one of the reasons why I was asking that question in my paper, because it is there. And so I wanted to see, okay, does the data really back that up? And that's what I'm looking at. Which is a really interesting question, because I've talked to people in the industry, whether it's investment consultants or it's CIOs of endowments and institutions, and they're like, oh, that's really interesting. I'd love to read that paper when it's done. So that's one side of it. Now you're also asking about with just portfolio construction. So there was a paper that I wrote, which actually became a chapter in a Wiley book back in 2004, 2005 on hedge funds, called Skewing Your Diversification. That's the name of the paper. You can also find that online. But it really looked at the idea of, can you complement hedge funds and CTAs together? There was a professor in London who had written a paper on that initially. I love the idea, but he had a short amount of data in there. And so I used more data and different indices than for what he used, and came up with the same conclusion that, yeah, hedge funds and managed futures can complement each other within a portfolio when you're allocating to equities and fixed income. So with that, they work together, but the question is, how do they work together? And what I found too, like in that paper, is that you probably want to give more allocation to CTAs than you do to hedge funds, simply because CTAs generally tend to be more diversified, non-correlated to equities. Hedge funds tend to have a stronger correlation to equities. Now, that brings me to more research that I presented at the Illinois Economics Association in 2009 and also at the Talking Hedge Conference in Austin in 2019. So both of them were in 2019. And what I was asking was a very simple question, is that if you have all these hedge fund strategies, are they all working for you? Because for the longest time, you had investors saying, I'm diversified, I'm invested in hedge funds, end of sentence. But are all those strategies really helping you? Are they meeting the goal that you are setting for your portfolio? So if you look at a lot of hedge funds, a lot of them tend to be trading in equities, fixed income. You get some that are more global macro, which are more similar to CTAs. And in that process, you start to find that, hey, you get a lot of these strategies that are highly correlated to equities. Now, if your goal is to have an extension of your equity exposure and to have some diversification, then going to several of the hedge fund strategies can be helpful. However, if your goal is really more of diversification, then there's a smaller subset of strategies that you want to go into. That would be, say, like managed futures, global macro, fixed income arbitrage. There's one or two others that would be helpful, that they tend to be more diversified or diversifiers for your portfolio, whereas the other ones tend to have more of a stronger correlation. Like if you look at a hedge fund index overall, so it includes a lot of different strategies in there, its correlation tends to be 0.7, 0.8, somewhere around that, to say the S&P 500. Now, if you start to parse it up and look at strategy by strategy, you'll see a lot of those strategies tend to still be 0.6, 0.7, 0.8, and then you'll get some that are bouncing between positive and negative correlation. And those are more of your diversifiers. And so there's, it's a really interesting question, because you really have to ask, as an investor, what's my goal? What do I want the end result to be of my portfolio? Anytime you put anything into your portfolio, regardless what it is, right? Stocks, bonds, real estate, hedge funds, managed futures, whatever it might be, the question is always, does it complement your portfolio? What is it doing? So that's something you need to think about with this. One other idea, too, to throw in here is that there's some things I've written about regarding volatility. And you think about standard deviation. And that standard deviation can be, people think about that as a metric for risk, but it's actually not really a great metric for risk, because what does standard deviation really tell you? Just how much movement you have around your mean. So you'll see, like a lot of CTAs, they may have high standard deviation, but they may also have positive skewness, which means a lot of their volatility is coming more from the upside. If you look, say, the S&P 500 or most equity indices, they tend to have negative skewness, may have a lower standard deviation, but more of their volatility is coming from the downside. So if you're adding in something that may have high standard deviation but positive skewness, that can actually reduce your portfolio volatility. Now, I tell that to my students, and they always go, how can that be? But when you start to combine it and allocate it, it's helping, because it's helping to smooth out the returns. So it's helping to reduce the downside and maybe even push you more towards the upside of your distribution.
That's great. No, I really appreciate that, and Mark, I really love the talk about the goal. I think a lot of people just kind of look at their portfolio and what's making me money or whatever, but it is also about the risk, and just building that out so you're protecting yourself and being able to create some value in markets at appropriate times. And that's very well said. So we are out of time. So I do appreciate everything, Mark. For the listeners, if you do wish to contact Mark about his research or just learning a little bit more, or digging deeper about managed futures, his contact information will be available to you at at the end of this presentation here. And everyone, take care.
Thank you.
Thank you for joining us for this Midland Pulse session. For questions or for more information on this topic, give us a call at 239-333-1032. We're here to help. You can also access this and other Pulse sessions by visiting www.midlandtrust.com/